I remember decade after decade where gold was hated. It was derided. Nobody owned any gold. We're just seeing the incipient inclusion of gold as a genuine ballast to your equity and bond sleeve. It's a genuine offset to occurrences that would make bond prices go down and stock prices go down. It's a genuine ballast in your portfolio, and it's a necessary sleeve in anybody's portfolio. It's been that way for me for decades, but now it's finally being embraced incrementally and on the margins by Wall Street. It's still nothing compared to what I think how much they're pushing cryptocurrencies. It's still, you know why? Because gold is the great revealer. Done again. It makes governments and Wall Street look like fools. It unwraps the folly of government and big banks. That's why they hate it so much.
According to Michael Pento, investors are anxious about the recent decline in gold and silver, but he thinks it's just market noise within a larger bull cycle. According to him, the foundations have not only remained solid, but have really gotten better. He claims that what's actually taking place is a healthy correction in a market that is still being driven by one unquestionable force: monetary collapse. In the meantime, the US government's deficit exceeds $1.8 trillion, and debt is currently growing more quickly than GDP. Gold will resume its historic position as the world's neutral currency when the dollar eventually loses its reserved status. The dollar may not completely disappear, but its worldwide dominance is rapidly eroding. Global central banks are already anticipating it. Treasury bonds are being dumped, and physical gold is being hoarded by China, Russia, and even US allies, not for financial gain, but for security. They are getting ready for the eventual reset of a debt-based system. That's the true tale, according to Pento. The long-term shift from paper promises to real value, not the short-term price fluctuations. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets.
And I know when a market has a down day, I'll hear from specific individuals who always are value conscious and they're looking to add on pullbacks. But go ahead.
So you have to evaluate: is this a trenchant watershed moment, epiphany in the precious metals market? Is the bull market over, or is it just a healthy pullback? And nobody knows for sure at this moment. God only knows, and I'm certainly not him. But I will tell you this: what has really changed? And the answer is nothing. We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar, because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026, who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday. I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing, and I think that accelerates under the new Fed chair, and coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So I mean, so there's nothing really changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So from the Congressional Budget Office. So deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction. China dumping their gold reserves, or Russia dumping their gold reserves. This is some kind, weak hands that said, listen, I'm up 100% in my precious metals miners, and I need to sell because I'm kind of panicked because they're down a little bit today. But in the long run, listen, I've been in this business for 30, how many years have I been in the business for? 35 years almost now. I remember decade after decade where gold was hated. It was derided. Nobody owned any gold. We're just seeing the incipient inclusion of gold as a genuine ballast to your equity and bond sleeve. It's a genuine offset to occurrences that would make bond prices go down and stock prices go down. It's a genuine ballast in your portfolio, and it's a necessary sleeve in anybody's portfolio. It's been that way for me for decades, but now it's finally being embraced incrementally and on the margins by Wall Street. It's still nothing compared to what I think how much they're pushing cryptocurrencies. It's still, you know why? Because gold is the great revealer. Done again. It makes governments and Wall Street look like fools. It unwraps the folly of government and big banks. That's why they hate it so much. Every fiat currency that's ever existed has gone to zero. So I don't think there's going to be anything different about the U.S. dollar. But at least, if you don't believe that, the very least you could say is that the U.S. dollar is going to lose its world reserve currency status. And it will. And people say, well, when is it going to be replaced by the yuan? China doesn't have a free-floating currency. Well, listen, it's going to be replaced by, and it's being replaced by, gold. Because gold is not, if China sells us excess goods and they have a currency surplus, and they used to want to park it in treasuries, which are backed in dollars, and those treasuries and dollars are now subject to tariffs and confiscations. And they say, well, wait a second, I'll just take my surplus and buy gold, and I will hold it myself. And that makes a lot of sense. It always makes some sense, because the United States can't steal China's gold. But you know what? It makes a lot of sense. The most sense is when the government of the United States is bound and determined to reduce the interest rate on those reserves. So it doesn't make any sense to park your reserves in treasuries that are on their way yielding back to 1 or 2%. It's just not worth it when you have the currency translation and you have the risk for confiscations. So it makes much more sense to hold your money in your possession in gold. And I don't think that's changed. I don't think that rationale has been disabused.
Although official statistics suggest that inflation is under control, Michael Pento cautions that it is silently rising once more. He claims that modifications are being made to the data, but the rate of change shows that inflation is undoubtedly accelerating. The Federal Reserve is taking the exact opposite action from tightening policy to combat it. Rates are being lowered, quantitative tightening is being stopped, and the money printers are being silently restarted. The Fed's balance sheet, which was only $700 billion before to 2008 and then skyrocketed to almost $9 trillion, is currently growing once more. Simultaneously, the reverse repo facility, which only a few months ago contained $2.5 trillion in surplus reserves, has been reduced to nearly nothing. That's a flashing red warning sign, according to Pento. It indicates that the system is running low on liquidity, and by flooding the markets with fresh money, the Fed is attempting to avert another repo crisis. However, he claims that adding liquidity to an already inflated system just postpones the reckoning and exacerbates the final disaster. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
When you're not moving the goalposts, as the Fed tends to when they don't like the number that they come with using the old methods.
Well, I mean, I don't have a number for you. I just know it's much higher than the hedonically and substitutionally adjusted. I mean, who cares? Does anybody invest looking at the CPI? I look at the rate of change of things. Actually, the second derivative is the most important thing to me. So it's the rate of change or the rate of change. And for me, it means that inflation is heading higher at a faster rate. So we're growing at 2.7% year over year now. This next print, whenever we get it, because the government's closed, but we're going to get a print on Friday. And I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating. And yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest rates. You won't hear this from the financial media. The reverse repo facility, this is basically the excess reserves from banks that they didn't need and they parked it at the Fed. And that was used to buy treasuries to make sure we had quiescence in our bond market, even though we're an insolvent nation. That was $2.5 trillion in 2022. Well, today it's effectively zero. So the Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the the threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. From $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked through. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week, I'm going to put a chart up of reserves in the financial system and showed how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet now they're adding those reserves. So you want to understand why people are pining for an alternative to the U.S. dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver, and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now.
According to Michael Pento, the government's official inflation figures are inflated by modifications, which make inflation appear lower than it actually is. He concentrates on the rate of change and, more crucially, the rate of change of that rate, or what he refers to as the second derivative rather than the consumer price index. The true trend appears there. Pento claims that inflation is not only increasing, but also increasing more quickly, indicating that it's escalating once more. He anticipates that the next inflation report will increase from 2% to roughly 3%, indicating a pickup in prices. All of this, according to Michael Pento, suggests that the Fed is afraid of another repo crisis, similar to the one that occurred in 2019 when bank short-term lending froze. By cutting interest rates and injecting additional liquidity to an already inflated economy, they are attempting to stop it. However, he cautions that this is a risky step because increasing inflation won't fix the issue. Rather, it creates the conditions for something worse, stagflation, which is a combination of high inflation and decreasing GDP that is followed by a crisis in the bond market. He believes that panic will break out in the treasury market when inflation and insolvency clash. Bonds will be dumped by investors, yields will rise, and trust in US debt will plummet. According to Pento, the government's standard strategy of creating money and distributing stimulus checks will simply exacerbate the situation when that occurs. He even calls the current plans for digital America coin stimulus payments ridiculous. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.